So here we are, China Tech, hotter than ever, right? And I'd like to ask each one of these venture capitalists, deal makers up here, to give their view over what they think about where we are now in China Tech investment, what they see as a big trend, how long this is going to last, are we in a bubble, these kinds of questions. So James, let me turn it over to you first. James Lee from Lightspeed, China Partners.
Yeah, thanks. So from Lightspeed view, we are focused on early stage TMT investments. So from valuation point of view, our entry price point usually is slightly up, but it goes from maybe 8 million pre-money, maybe go up to 16 million for really high quality founder team and with some products on the market. But what we see, the biggest change is the later stage. So I have 3 portfolio companies we invested within the last 2-3 years in Series A and B, and now both are raising over $100 million at a valuation around $1 billion. And so certainly you see DST has started the game that they put a lot of money in these, they call unicorn company, and really try to delay the IPO process for them. That drives up the valuation for private companies. So that, I think that's happening. But I think one reason that Joe kind of mentioned, that DJ mentioned, there are a lot of capital. And we are a global fund too, although our China fund is independent from the US fund. From LP perspective, the pecking order in the world venture investment is US is still #1, China is #2, India is coming up, and the US valuation is very, very high. So you see that a lot of dollars want to get into China, that's driving up the valuation.
Right. And how long do you think this is going to last?
Well, I think it's very different from 2000. I started my first startup in 1999, and I raised $8 million for my Series A. I would say that was a bubble time, right? A lot of companies went public at that time. There's very little revenue. But here today, company may not be profitable, but they really have really high growth revenue projections. So that makes a difference. And in China particularly, I think a lot of the companies are not pure internet companies. And the government now says internet plus. Yeah. It's really true. It's really, Joe mentioned that the traditional business is so weak, and internet and mobile really can transform, including efficiency. When you think about the sharing economy, all these elements together in the context of the weak traditional industry, that the new startup, they're doing real business. They are not just building a virtual community. They are really creating revenues and disrupting the tradition. So I think that will last long. Although the valuation, I think it will come and go. And the biggest valuation increase, I think, is actually not in the US Chinese stock IPOs, but in the domestic market. You've probably seen in the past 6 months, right? And one company we invested, mobile internet company, we took the company IPO last year, and the market cap today is $10 billion US, and we invested just 4 years. So those PE multiples will come down, but I think it is part of the bubble, but it's driven by the substantial underlying business growth.
Okay. Good. Lee, what's your viewpoint?
I think we're at a very special time. If you look at what's happening in China, there's really a lot of things. James mentioned about the booming of the VC industry. China is becoming #2 in the world. The stock market is having huge reforms. The third board is opening up. There's regulation changes to make it more register-based. There's a flood of companies are changing its VIE structure potentially to be listed in China. New funds are being raised to support this transition because it will require changing the shareholders from US dollars to RMB. And if you look at the reforms, there's almost in every sector, healthcare, in education, in SOEs, because the SOEs are going to include private investors as one of the major push. The new Silk Roads are being proposed and are are in progress. The new kind of IMF type of, the new World Bank type of structures being formed, the anti-corruption. So this is a very special time. A lot of things are happening, and there's probably more than ever. So I would say every Chinese are not at an easy time, because everyone's, it's not a time that you can be complacent and be very, how to say, very, not be nervous or paranoid about what you're going to do next, because changes is around you at every corner. And as a VC, we also feel that. I think we've seen some of our competitors investing in 100 companies a year, over 100 companies a year. Some single investor investing 30, 40 companies a year. So they're kind of really testing the limits of the VC industry. I don't believe there's one way to make money in the VC industry. I think you can, anything you're innovative, you're first, probably can make money, or you have to be very smart, right? I think this is like in the Twin Cities, this is the best time, but this is also the worst time. I believe that the valuation will have corrections. And there's anything, this is like a law of physics. There's no way that the valuation can sustain. Not necessarily will have a big impact on early stage investors like James and I, because I think changing the valuation from 10 million to even 30 million won't really change our business. I think our business is still trying to find the best entrepreneurs and to make billion-dollar companies. But the difference is that some of these companies are growing valuations so quick. Even as VC, we're nervous. One of our portfolio grew to 500 million valuation in 4 months, and several also over $1 billion valuation, and some $7 billion valuations, and still not public, right? There are a lot of unicorns that we see, and whether these unicorns all going to be billion-dollar company, personally, I doubt it. I don't believe there's going to be so many multi-billion-dollar companies in the next few years. Many will have challenges, and it's very natural. I think in VC industry, valuation only is it's one metric of whether this will be a successful company or not. Many companies go through these roller cycles, and if you go through several cycles, you will know that valuation it doesn't really mean you're in a safe zone. In the past, probably, if the company over 100 million, you feel you were safer. Today, I think even if you're over $1 billion, the company may not be really safe. I think things are changing extremely fast. And this is, the technology is changing. The new ways of interacting with your consumers and the applications are changing. And in some cases, if you are a billion-dollar company and yet you haven't get on the next trend or next wave, you will face a very tough situation. I think in some of our portfolio we run into this type of challenges in the past. So it's a time that need to really focus on what you're strong at, and don't. I think the traditional way of doing VC, there's some merits, but you need to find new ways to innovate. But at the same time, if you stretch too far, you will also have a lot of challenges.
Not a time to be complacent. Chun?
Yeah, I would like to see the technology into the two different categories. One is a type of technology used to solve a certain problem, and another type of technology in the VC community right now we call deep technology, right? Can fundamentally change the future. So in China market, actually it's very difficult to find the deep technology deals, because this is not really an environment to create innovation in the deep technology. One example in our portfolio, like our second interview today, Dealmaker, Frank Wang's company, he's using actually his background from mesh networking, so he's easily applying this technique, right, the Wi-Fi technology into mobile-to-mobile large file transfer and quickly grow to 300 million user base. So that's a typical example in China. It's a China game, right? Using the existing technology, Silicon Valley technology applied to a huge market. Of course, certainly it is sustainable. If we talk about the sustainability, right, and vulnerable probably to the financial market, and another factor is a government policy. And if we look at the deep technology, in Silicon Valley, we do invest in those kind of company. And of course, it can last, right? Relatively, it can last longer.
So what's your forecast of how long this cycle is going to last? This up cycle?
Right. I'm not a financial person, so I don't have that crystal ball. Right.
Well, even so, you're a venture capitalist, so you have to think about the horizon.
Yeah, so in this sense, we carefully look at all the deep technology type of company and prepare for the winter. Right? It's
Preparing for the winter.
Right, right. And for those fast-growing companies, we just hope we can control everything very well and be sustainable.
Yeah. Okay, good. Michael?
Yeah, I think I agree with most of them, but well, I mean, I want to point on my point that usually when people talk about bubble, that means we pretty much say as to a degree, and I think well, as you know, the change is there, and usually means the players to change, and that's what to change. So the only thing you need to do, I mean, from my portfolio perspective, I will encourage you to raise as much money as you can. It doesn't really matter when the winners can come or the cycle's over. I'm not going to able and I don't want to. I'm not going to be able to predict that. I don't want to predict, but I think you have to raise as much money as possible. Not because you don't have the money, it's because you have to. First of all, you don't know when the winners come. And second of all, I think as Joe just mentioned earlier, I mean, the competition in China is very fierce. If you don't have a competition in the business you're in, you're probably in the wrong business. Which means you have to arm you up. You have to have enough cash, which means you probably can have a deep enough bench in your team. You probably can do a lot of attachment. You probably can have you probably can make more mistakes than anyone else. So, you know, I would just encourage my portfolio just to ride on the cycle, basically take advantage of it. From a firm perspective, of course, I think I will take more cautious measurement in terms of the especially high value deals. But I think we pretty much all focus on every stage, so I will agree with you know, my fellow panelists' points that we don't affect by the cycle that much, but I'm a little scared. But in the meantime, I would encourage my portfolio just go ahead with take the money we can.
But from the VC side, you're being more cautious.
Of course, of course. I think we are early stage. I think early this year, I do witness there's some cautiousness for the growth VC or PEs. They all try to move early, and they are sensitive about the price. They do put big back on the winners, especially the number one in the industry. But for number two and number three, I think they're more cautious, and they're not willing to pay up. I think that's definitely the trend here. So, you know, as long as you can raise money, as I pointed earlier, I don't think you just have to raise money.
Kefei?
Yeah, I'm an IPO lawyer, and so from my perspective, is it frothy? Yes, and I like this to continue as long as possible. Right? So, you know, how is it frothy? I think a couple of phenomena. One, you know, I myself do more Hong Kong IPOs in the US. So in the Hong Kong market, what I'm seeing is these traditional line companies sort of are increasingly trying to increase their valuation by sort of bolting on internet concepts. So we just finished a deal that's a property management service company. So they came out with O2O concept. So it's like $1 billion company. Okay. So we're working on another one. This is the same concept with a bunch of people from sort of ex-Alibaba type people, right? So. And there's a VC that invested in this that are counting on this concept to work, and I think it will. A couple of years ago, alternative financing was popular. Now they're not so hot. So some of my clients to be are figuring to bolt on P2P concepts to this company, and that's worked for a couple of listed companies. So that's Hong Kong. I'm also seeing, a couple of my clients, clients I'm kind of chasing, are no longer going overseas. They are trying to list on the new, we talked about this, the new OTC BB board, Shenzhen. Okay, now I'm totally confused about this market because it has 3,000 companies listed on it. Like liquidity only with 1/10 of them every day. But apparently a lot of people are getting wealthy off of this. So it's a quick process to list. It's like 3 months, it may a couple of things they may be trying to do. One, they're trying to get listed there and then transfer to the A-share market. Okay, and I'm not sure how if that process has been worked out. Two, one of my clients is saying, okay, we list there and we get a really high valuation, and then we list in Hong Kong and trying to force the valuation up in Hong Kong. Okay, and I'm not sure if that works. People have to buy your stock. Nobody's forcing anybody, right? If there's anybody that's expert on this new OTC board, or OTC BB board, I'd like to talk to. But yes, I think it's a frothy market.
And IPO versus M&A, where do you see that trending in the future as an exit strategy for an entrepreneurial company?
So I don't do as much trade sales, but there are a lot of companies that obviously want to sell themselves to the BATs. Now, in the gaming world, I have a buddy that sort of works with the A-share companies, and what they do is they do follow-on offerings and use the proceeds to buy up these gaming companies to raise their valuation. So everybody basically makes money immediately after the buy. So they do this, on an ongoing basis. I'm sure he's doing quite well.
That sounds like a fascinating strategy. Actually, for the VCs here, Mike, you touched on this a little bit about more caution in terms of what you're looking at to finance. Is this kind of a nerve-wracking period for the VCs to be in, where you see all these high valuations and a lot of competition for deals, and you might get squeezed out. It might hurt you in the long run to be investing in this, but if you don't invest in it and go with the flow, then you might miss out on a big home run. So how do you deal with all these factors in the market?
Well, I think we just try to be more picky in terms of choosing deal. I don't think we should be at any point.
But do you look for in new places? I mean, is it possible to find anything that's undiscovered?
Well, yeah, I mean, that's definitely one strategy. You go early, you go somewhere new. It's always one strategy, but I think just in general, we never stop investing. It's just a question of the pace and how much.
Have you slowed down this year?
Not quite. Not quite.
How many deals are you expecting to do this year versus last year?
Last year we, I think executed probably about 20.
20.
Yeah, probably this year we're going to do slightly lower, but
About the same this year?
15, 16.
Yeah, a little bit less. Okay.
Yeah, because, the market is good. Probably focus more on the exit. It makes sense because they have higher return. And we get more picky on the price for the sector we should be investing, or the team we should be backing. But like I said, I'm willing to pay up the winners. I don't think we should ever be slow at any market condition. But the pace and size and pricing is all adjusted given the market condition.
Okay, Chun, from your perspective, your view on that issue of what's a VC to do in this kind of market where it's kind of a nerve-wracking market to be in?
Right. If we invest for China market, because the huge wave is the so-called Internet Plus. This is O2O or connect to the combined with the traditional business. And in that sense, if the new venture stay close to money, right, and can have a very concrete, solid monetization model, business model, so that could be a good play. And in the U.S. market, since our fund, the TEEC Angel Fund, is focused on the Silicon Valley, so we have a luxury to pick the deep technology company that's really very rich in Silicon Valley, right? And potentially could be more cheaper in the future.
What about the pace of deals at TEEC then? How many deals do you expect to do this year versus last year?
Yeah, typically we do like a 30, 40.
30 to 40.
Right, yeah, eventually.
Right.
Yeah.
And the average deal size is?
We are angel fund, very small.
Yeah, so very small.
Right,
30,
typically
40,
we
very
like
small.
200, 250. Okay. Yeah.
Okay. You gonna slow down at all this year in terms of investing?
Market is hot. We see more and more deals popping up, right? But we carefully pick the two types. One type is deep technology.
Yeah.
Another type is very risky. Could be like new business model innovation. Those type of company.
All right. Smart strategy. Lee?
I think the A-round valuation sometimes can get pretty high, but I think it's not really a major concern. I think for us is still trying to find the quality entrepreneur and invest in it. One of our deals we actually did it's a seed investment. Seed was two A-round, total $13 million US. It's a lot of money for A-round, about $40 million pre. So you can say this is a very high valuation, but the company has acquired about 50 million users in 4 months, and the next round is 400 pre and 500 post. So I think it's still about, if you can see quality entrepreneurs, I think the valuation is secondary. I think you still invest them is very important. The tricky part is actually how much you're going to invest when the company get to $1 billion. Even you do pro rata is a lot of money, right? And when you raise a $100 million round and your pro rata is 20 million, what do you do with it? That becomes a pretty important decision, because it's at that point, even at $1 billion valuation, it may not be safe. So that's it's a bigger decision. When you make some mistake investing $2 million, $3 million deals, it's okay. I think it's at the end of the day, if you have some home runs, you will still be able to recover. But if you make a lot of mistakes at 15 million, 20 million, then that will make a much bigger impact on the funds. So I think that's a tougher decision for us.
James?
At Lightspeed, we have certain strategies that we really kind of think ahead in 3-5 years down the road what new changes potentially will happen, and we try to do early investment for that. For example, fintech is one area we invested 4 years ago. There's a company called Room 360, and at that time nobody talked about Tino, but we were lead investor for that. But certainly we really want to capture big unicorn, because the return for VCs usually is largely driven by these big outcomes. Like the company I just mentioned went public domestically in China We invested for 4 years, and the $6 million now turning into over 600 million return in 4 years, right? You want to capture that. So the Internet Plus O2O is a big area, and we really put a lot of focus on that. The sharing economy, the Airbnb equivalent in China is called Chun. We were the Series A investor for that company. But I think the strategy is slightly different, like the mobile social network. We tend to do more seed investment because we feel the big opportunity for mobile social network is always there because it's driven by young people. And in the US, Snapchat now is the big threat to Facebook because they capture majority of the under 35 demographics. Young people always want to try something different, right? And we were the seed investor with Snapchat. So the $1 million for 10% really worked out very well because you can never predict. This is a Stanford drama, right? And, but we really take a different strategy for that. But one area I think is under radar is actually what the previous talk about the enterprise area. And we studied in the US, $1 billion IPO. There's more $1 billion IPO in the enterprise space in the US compared with consumer. China is way behind that. A few things happened in the past 6 months. You probably heard about the Snowden disclosure, right? And so the Chinese government now is putting up this policy that really want all the big banks and the big companies to use domestic products. And that coupled with the US trend with kind of get rid of the IOE and with everything driven by the cloud, that creates opportunity for Chinese startups. And so big data is one area that is very, very important, but we actually place bets in cybersecurity, SaaS space, and so that's the area that, to give you an example, we invested in a company last year. They are becoming, it's a Chinese company. They provide a core product in advanced data center. Last year they did about 120 million revenue, about 12 million net profit, US dollar. And we were able to negotiate a price which is pre-money was 90 million, which is a kind of a 7 times PE. And their business is 70% is from US revenue, because the top US companies are using them. But because they're under the radar, so you can still get a very good valuation as an entrepreneur. So this is where we think it's good for entrepreneurs to look into because the labor cost is going up, and Chinese companies really need to improve productivity and really spend more on the space.
I'll add a little bit about the opportunity. I think Northern Light is kind of more diversified. So internet, mobile internet is one part, but we're also investing in cloud computing, semiconductor, clean tech, healthcare. Right? What we see is that in a lot of these sectors, China is not only about internet, actually. If you look at the technology, we continue to invest in the past few years in the environmental protection, new energy space. We have two companies filed IPO recently and one about to be listed in China, and very profitable. And when we get into these companies, are very low valuation, and there's not much competition because it's tech and it's not a hot sector, because very few people are chasing this sector. But there are a lot of opportunity in this space. Even on the solar side, we invest in a virtual power plant company. It's an asset light, but managing the power plants. This is their first year, they're getting $20 million revenue. So China has a very specific situation. There's always opportunity popping up, but try not to follow the others and finding the unique opportunity for yourself.
Is it still true that in the VC business you get one deal out of maybe 10 that's a huge success or a success? Is that still kind of the 1 in 10 kind of risk-taking formula?
I think I think Matrix announced some of the data. I think 30% of the company died so far, but 70% still exist. In China, I think for a company to exist actually is a lot simpler because the burden is low. But I think driving return is probably always 1 or 2 companies drive most of the return. If you see your portfolio, kind of 6, 7 companies are driving similar return, probably you just didn't catch the unicorn. That's probably not a good sign.
So besides raising a lot of capital right now, what is the number one advice that you're giving the entrepreneurial companies? This is my last question because I know we have to close soon. But besides raising a ton of capital right now, what's the number one thing that entrepreneurs should be doing internally?
Internally, in a startup, I think the position is always very critical. Yeah. So predict the near future and have a laser focus on the big wave. So in China market, of course, the internet plus is a huge wave, and the U.S. market is very funny. It's quite different, right? It could be internet of everything. So it's a totally different perspective, right? In U.S. it's a more technical play, but in China it's more spiritual play.
More what?
Spiritual.
Really?
Yeah, because we talk about internet spirits, internet philosophy. So it's a different angle. Yeah, so then you can see easily create a different type of company.
So you're pushing your companies to go for the exit strategy now quicker than before, or not? Yeah, all of them. That's definitely a thing that you capitalize on it right now.
I think it's we've had experiences where, let's say, one of our portfolio had 20 million profit a year, a quarter 20 million profit, and the next year things change, and you have to sell the company to someone else, right? So I think while you can go IPO, and don't try to wait until you get the optimal timing. I think that's our suggestion. Second is the valuation metrics will back to fundamentals. I think today you can raise money based on number of DAUs, daily active user, monthly active user, but in 6 months, I think this will change to what's your PS ratio, right? Or I think if we move to PE ratio, I think most companies will be in deep trouble, right? Probably will first move to PS ratio. So revenue, that's something you've got to focus on.
James, did you want to add something?
I think my advice for entrepreneurs, really, if you find your passion, find a big area, go do your startup. This is probably the best time to do startups. And there will be a lot of capital, but be smart to pick the right investor. Do some due diligence and partners. Investor do DD on company, do the same on the investors. And our lesson is, what's the most important things for startup success is, number one is the team, quality of the team. Number two is the big direction, and what are you working on? You want to work on something big. And the third one is actually the quality of the co-investors. Sometimes it's a good company, but if the investor is not as good, can really sometimes make a mess. And but this is really one of the best times to do startups. So.
In China.
Yeah.
Okay.
Yeah, I have to agree with what Jim said. I think this is definitely probably the best time ever. My general advice will be just be aggressive in this small position. Because if you become lifter, there's no room for it to survive. Not only on a fundraising perspective, also recruitment, marketing. Even VC need market. And I think that the entrepreneur in China getting more mature. I remember when I first got into business like 12 years ago. There's when we talk about the term sheet, you have to like explain line on line to the entrepreneur. Now they just came in and they know what the term means, and they just tell you that's what I need. So I'm sure they're getting more mature and knowledgeable about our business. But I would like to invest in a more aggressive team in every aspect, not just on fundraising. Because if you're not aggressive, you're going to be killed at some point. Because of the competition, because the short of capital, everything. So just be aggressive.
Okay. And if you're all pushing companies to exit more quickly now, this is going to make Kefei very happy here as an IPO lawyer here at the end. So Okay, well, thank you very much. Any questions from the audience? Just last question. I'm going to scan really quickly. Anybody over here? Okay. Andy asked a question already. Oh, there's one in the back. I think I saw you. No? Okay. All right. I think. Nils.
Yeah.
Just get a mic to him, please. Thank you.
Thank you. A question about your last comment there, Michael. As someone having watched the space for a while, I feel that the advice to be aggressive is one of the reasons that valuations have gone up as much as they have. VCs have felt that spending money on the problem is the same as being aggressive. Isn't it about time that we start thinking about being efficient instead of being aggressive?
Well, I think being efficient is part of being aggressive, right? Because, well, I mean, I've been telling my portfolio, or the way I evaluate a new deal, one of the key points I evaluate the team is, can they raise money? I mean, that's very important. And they have to know when they're going to raise money. Give you an example, we invest in a company called Tunyo in 2008. At any run, I don't think the company needs any money. But if they don't raise the money, they will squeeze out by their competitors. Even after the IPO, they still announce a price war against their, not they announced, but it's being announced by their competitors. So I completely agree with Joe's comment early on that, you know, in China the environment, because the market is so big, the competition is always inevitable. So as a team, as a startup entrepreneur, you have to prepare for that in every aspect. So, you know, you have to be cautious for sure, but you know, being aggressive is you know, the best defense is the offense. So that's how I see it. You know, efficient sometimes means that you have to raise money and spend it wisely. It does not mean that you just sit there and wait until the valuation, you know, the market cool off. Especially from your perspective, you're an entrepreneur, and you probably want to raise money as much as you can, as high as valuation as you can, because you've got the least, right? And while you have the money, yeah, sure, you should use it wisely. And everybody's paying for that. And I a little bit disagree about the cost in China. I think the cost in China is definitely way too high, especially in Beijing. Several of my portfolio, they moved their R&D from Shanghai to Ningbo, the second tier city, because first of all, it's much lower. Second of all, it's not easy to be recruited by some of their competitors. So it's tough. I mean, that being aggressive means you have to rearrange the cost structure and probably operation as well. So my point, be aggressive is also be wise. Just not spend the money stupidly. But you have to be up there, right? When you have to let the market know your existence. Right? Otherwise, it will be definitely washed out. Even after market cool off, nobody can know you. I think that's the key. But you know, I know you're in 2B business, so it's big slightly different from 2C perspective. In 2B business, I think it's point-to-point business development, and there's a limited audience when you do your marketing. You probably similar, it probably makes efficient way. But 2C businesses is definitely have to spend money. For example, when Tunyo go public, we spent over 10 million, I think 10 million RMB to, you guys probably see that, he hired Lin Sidley and his son doing the commercial, like 5 million, but they paid out like 10 million RMB. But it worth it, We got a pretty good IPO price. So that's what I mean, be aggressive. You have to spend the money to earn the money. That's
okay. Thanks, that's very good advice. Thank you very much, Michael. And on that note, I'd like to close our session here and give our VC Dealmakers a round of applause.
Thank you.